Ever feel like you've stepped into like the twilight zone when it comes to the stock market? We're talking record highs, whispers of a bubble, and now analysts at Citigroup are saying we might be on the verge of a repeat of last year's 10% drop in the S&P 500. Don't worry, you've got the deep dive on your side. We're about to unpack all of this, and luckily, expert speaker is here to guide us. So, expert speaker, what's got Citigroup flashing warning signals?
Well, they're seeing a lot of what we call long positions on the S&P 500 futures, basically bets that the market is going to keep going up.
No.
And these positions are at levels not seen since like mid-2023.
Okay.
Now, on the surface, that might sound like a good thing, right?
Yeah, more people betting on the market to rise. Usually that means things are going well.
Right, but think of it like this. Imagine a beach ball being pushed underwater. The more you push it down, the more pressure builds up, and eventually something has to give. That's kind of what Citigroup is worried about with all these long positions.
Yeah, no. Okay, I'm starting to see where this is going. Too much optimism can actually create a risky situation. But before we get to whether we should all be shifting our portfolios around, let's rewind for a second. For those of us who don't speak fluent Wall Street, can you break down exactly what a long position is and why it matters?
Absolutely. In the simplest terms, a long position just means you're betting that the price of something, a stock, a bond, even a futures contract is going to go up. You're hoping to buy low and sell high. It's the opposite of a short position, which is a bet that the price will go down.
Got it. So in this case, we're talking about people piling into these long positions on the S&P 500 futures. They're basically saying, we think the market's going to keep climbing.
Exactly. And to be fair, there are some solid reasons for that optimism right now. The economy has been surprisingly resilient, and the Federal Reserve has actually started cutting interest rates, which usually gives the market a boost. But, and this is a big but, Citigroup is saying these long positions look especially extended.
Especially extended. That sounds like analyst speak for buckle up.
Pretty much. See, last year around this time, we saw a similar setup with a lot of long positions, and then things took a turn.
Here's where it gets really interesting. Tell me more about what happened last year. Because that 10% drop in the S&P 500, that definitely got everyone's attention.
Last year, the market took a bit of a tumble, with the S&P 500 dropping 10% between August and October.
Right, a drop that big, it's not nothing. So what exactly caused that downturn?
It was a confluence of factors, but a big one was fear. The Federal Reserve was raising interest rates to try to get inflation under control. Investors were worried that those rate hikes would slam the brakes on the economy, pushing us into a recession.
So it sounds like investors got spooked, started selling off, and that's what triggered the big drop. Kind of like a mass panic situation.
Yes, exactly. When investors are afraid, they tend to sell first and ask questions later, which can create a self-fulfilling prophecy. The more the market falls, the more people panic and sell, driving prices down even further.
Okay, so last year fear was a major driver. That makes sense. But what about this year? Are investors feeling the same kind of anxiety? Because from what I'm hearing, the overall sentiment seems much more optimistic, right?
You're right. This time around, there's a lot more confidence in the air. The economy has held up better than many expected, and the Fed's decision to start cutting rates has injected a dose of optimism. People are feeling more confident about the future, and that's reflected in those high long positions we talked about.
So we've got this interesting dynamic. On one hand, we've got those warning bells from Citigroup, pointing to the potential risks of all those long positions, especially given what happened last year. But on the other hand, the overall mood is much more positive this time around. So how do we reconcile these two things? Is it really a case of déjà vu all over again, or is this year fundamentally different?
That's the million-dollar question, isn't it? And to answer it, we need to dig a little deeper into Citigroup's analysis, because they actually point out a key difference between the current market setup and what we saw last year. And it has to do with something called profitable positioning.
Profitable positioning. Okay, I'm intrigued. Break that down for me.
Essentially, profitable positioning means investors are sitting on a lot of gains right now. They haven't had to squeeze as much profit out of their investments this year compared to last year.
So are you saying that because investors are already in a good place, they might be less likely to hit the panic button if the market starts to wobble?
Precisely. Imagine you bought a stock last year at $50. And it took a bit of a hit during the downturn, but now it's back up to, say, $60. You might be a little more inclined to hold on to that stock, even if the market gets bumpy, right? You've already ridden out the storm and come out ahead.
That makes sense. But what about someone who bought that same stock this year, maybe at $58? They haven't had as much time to build up those profits.
Exactly. They're starting from a different point and therefore might be quicker to sell if things get shaky. That's the key difference Citigroup is highlighting. Because so many investors are already sitting on gains this year, they're less likely to panic and trigger a massive sell-off, even if there's a market correction.
So it's almost like a built-in cushion of resilience this time around. Does that mean Citigroup thinks we're in the clear, that this time it really is different?
Well, they're definitely not saying all clear. Markets are complex and unpredictable. There are always risks, and there are a lot of factors we can't predict, like unexpected economic news or global events that could spook investors.
Right, those curveballs always seem to pop up. So what's the takeaway for listeners? What should they be thinking about given everything we've just discussed?
I think the key takeaway here is to be aware of the risks, but also to keep a level head. Don't let fear drive your decisions. If you're worried about a potential downturn, it might be worthwhile to revisit your portfolio, make sure it's diversified, and maybe even talk to a financial advisor.
Solid advice. Knowing what you know, are you doing anything differently with your portfolio right now?
I can't give financial advice, but I will say this. I'm definitely keeping a close eye on market volatility and making sure I understand the why behind any big moves.
Smart. Well, listener, there you have it. It's a fascinating moment for the market with a lot of conflicting signals. On one hand, those record highs and a sense of optimism. On the other, echoes of last year's volatility and Citigroup's warning about potential risks. So here's your food for thought. How much weight do you give to historical patterns? Are you the kind of investor who trusts the current wave of optimism, or are you taking a more cautious approach given the potential for a repeat of last year's downturn? Let us know your thoughts. We're always up for a good market debate. Until next time, happy investing.